Hello and welcome to episode 463 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm good, and well, it's great after last week's video episode. So we did a new version of the podcast that we streamed on YouTube that went out at the same time as the audio version on your podcast feed, and we're doing it again this week. It's going to be a new trend, and the feedback we got from listeners is they really liked the YouTube version, so please do go and check out the YouTube version. And those of you who went over there and asked questions or left comments, and even the person who just said they left a comment to feed the algorithm, that was greatly appreciated and did make us laugh in the office. So do go over there if you want to have a conversation, chat anything, say hi, try and win a mug, then do go to the YouTube version of the podcast and leave your comments over there and engage with us. So we're going to be doing this going forward, as I mentioned, and I think people have really enjoyed it, and we're using some of the clips that don't necessarily make it into the podcast as well on our social channels. And the one thing I've got to say is last week we explained that we're doing lots more on our social channels, so Instagram, TikTok, YouTube. Do make sure you go and follow us on those channels. Pause the show, go over there, follow us. There are links in the show notes, and the reason that I'm banging on about this, because last week I said this and we forgot to put the links in the show notes until about a day later, so we're putting them in this week. Do go and follow us. It would be greatly appreciated, and please do engage with all the content that we're putting out there. And those of you that have been doing that this week, and there has been a number of you that I've been writing back and backwards and forwards with, then that again is really appreciated.
And of course, please do leave us a 5-star review in the usual place in your podcast app of choice, because of course, you know how it works. That helps feed the algorithms and lets us reach more people.
And also increases your chance of winning a Money to the Masses mug. Now, I've got to, before we move on to what's on the show, I've got to read you this review, Andy. You've not seen this because you don't have a iPhone, so you don't see the reviews. Now, the review that was from Chris Pedals, and I want you to read it out to you to see your reaction. And the headline is National Treasure. Have you ever been called a national treasure before, Andy?
Not in my life, and not in my life did I ever expect to be called a national treasure. I'm assuming it's more sort of steered towards you, but I'll take it.
No, let me read the rest of it. Damien and Andy really do provide the financial updates that you need to know. From energy price caps to stock market movements, they give people the confidence and know-how to make their financial decisions. So it is definitely describing us as a double act, I think, Andy. So if that was you that left the review, please do write in to the usual address, damien@moneytothemasses.com, and claim a free Money to the Masses mug, because I think that is well worth a free mug. National treasure, Andy.
Okay, so let's get on with what we've got coming up on this week's show. Damien, we've got 3 pieces as usual.
Yes, so the first piece is an investment piece. I'm going to be talking about stock market valuations. Where are the cheapest stock markets in the world right now? The second piece I'm going to be doing is in relation to some changes to the overdraft fees for some people out there. So some customers of certain banks are going to notice that their overdraft charges are going to creep up, the rate they're being charged. And the final piece on the podcast, Andy, you are going to be doing...
Yeah, I'm just going to be doing a very quick piece on car insurance. We talked about car insurance a few weeks ago on the podcast, and this piece is kind of a follow-up for that. And we're going to be looking at the 3 important questions on your car insurance that you must ensure you get right, for 2 reasons really: for cost, but also to not invalidate your insurance, which is happening.
So we'll move straight on to the first piece on the podcast this week. Now, this is in relation to stock market valuations. Now, people who have listened to this podcast in the past may be aware of something called CAPE. Now, every year I tend to do a piece that looks at which are the cheapest stock markets in the world. Now, there are various ways in which you can look at valuations when it comes to stock markets, and the one that I particularly like is one called CAPE. So the cyclically adjusted Shiller PE. So the abbreviation is CAPE, and it's a measurement that was created by Nobel Prize winning economist Robert Shiller, and obviously it got a lot of attention when it pretty much predicted the US stock market crash of the late 1990s, so that dot-com bubble that burst. And in a nutshell, CAPE measures the price of a share compared to its earnings ability over the last 10 years. So it's a backward looking measurement. Most of the things you see in relation to valuations often are forward looking. And to put it simply, the bigger the number, the more expensive or poor value a share or stock market is, and the lower the CAPE value, the cheaper it is or better value that particular stock market is. So you can use this valuation method for entire stock markets, or you can even look at it at a sector level. So I'm going to look at it as well at the sector level for the S&P 500. Now this comes off the back of a piece of research I've just published for 80/20 investor members. And so I'm not going to give you all of the detail, firstly because that's for subscribers, but also it wouldn't make that greater podcast to listen to. So I'm going to give you some of the highlights. So some of the markets that are interesting, that are more expensive maybe, or based on historical norms, cheaper. So they may be attractive in terms of valuations. Now the idea, if you start to invest based on value, is that if a stock market or even a share is good value, then the aim is, as a value investor, is that you are investing in something that is going to hopefully revert to norm. So the historical norm, that you've bought it on the cheap and therefore it will revert to its historical norm maybe, and therefore you make money. Usually for a value investor, it's because they know something about the company that they believe means that it's undervalued, and the rest of the market is obviously undervaluing that. They buy in, then the rest of the market catches up with the reason why it's undervalued. Maybe there's something that the company is doing or whatever, that they suddenly get excited about the company or the market, they buy into it and it pushes the price up. And if you've got in early as a value investor, then of course you will be benefiting from that rise. But of course with value, it is a difficult measurement because sometimes things are cheap for a reason, because they aren't any good, and you can have value traps. But we'll put that to one side. As a podcast listener, and if you're an investor, you don't have to be into buying individual stocks or shares, but you might be thinking about, well, if you're going to invest in certain markets, is there any that are undervalued based on history that you hope that might suggest may be about to enjoy a movement back towards their norm? Or equally, are there some expensive markets that could see a crash in the future? Now, the thing you've got to bear in mind, CAPE is not a crystal ball. Is no guarantee that just because something appears expensive against a historical norm that it will, for example, crash. Now the best example of that is the US stock market. That's had a CAPE level that has been way in excess of its long-term average, which is about 16.4. It's for the, well, I can go back to 9 years ago when I originally was looking at some of these numbers, and it was way above that level. It was at that point 27.74, and we've had ups and downs in the market, but we haven't had a major implosion causing the market to move back to that long-term average of 16.4. So with all that said, which markets are expensive or not? So I'm going to give you a reference to the median CAPE over time, and also with where it was in August last year, the last time I actually looked at these numbers. So if you're looking at the data, and I looked at markets in developed world and emerging markets. So when we talk about developed markets, we're looking at things like the UK, the US, and most of Europe, but there are emerging markets as well that I've touched upon. So given that I started with the US stock market as a whole, then the long-term average for that CAPE measurement is 16.5. Well, at the moment, that is actually at 34. It was at 31.6 this time last year. Again, it's just a sign that because something is expensive, it doesn't mean it's necessarily going to crash. But the warning signs, if you are a follower of CAPE, that the American stock market is overvalued. Now, looking at the UK, the UK has been really interesting because it has been a bit of a laggard. And if you follow my market updates that I do every month, you remember that the UK stock market was the one that was lagging when other markets like the US were rallying hard, and particularly into the beginning of the first part of 2024. Now, the long-term average, the CAPE value is 14.7. Now, this time last year, we were looking at 13.2. So the market was cheap. Now, the CAPE value is 14.9. So it's just crossed over the median value. So it's around its long-term historical average, just moving into that expensive territory. And that's because the stock market in the UK has rallied quite strongly of late. We've had new all-time highs. So This time last year, there was a value opportunity, not so much this time around. So if you'd been somebody who'd followed the CAPE measurements as an opportunity to invest in the UK, then you've done very well. Now, moving on to other markets. Now, some of the markets that have got the widest measurement, or widest gap, I should say, between their historical average and their current CAPE. There's obviously the US stock market, but another stock market is the Indian stock market. So we've had the Indian stock market rally strongly into the first half of this year. Now, again, if you've seen my market updates or you've followed 80/20 Investor, in recent notes, the Indian stock market had been rallying incredibly strongly. It was a very strong and profitable part of my own 50k portfolio that I run live on 80/20 Investor. But it had a wobble around the Indian election, and the result that came in last week saw the market rally, I think, by about 6% one day, fall by 8% another day, and then it's actually started to settle down. But Indian equities have been a strong performer year to date, and so they were expensive this time last year. 30.2 is a CAPE measure back then. The long-term average is 21.9. They are even more expensive now, so that's 35. So if you follow valuation metrics, then that might be flashing a warning sign. Don't forget, these are for the wider market. Of course, you're always going to have value opportunities even within expensive markets. This is just giving you a general theme if you're looking at it from a geographical point of view. If you want to go down the other end of the spectrum, where is the CAPE value saying that there is a value opportunity? Then some of the widest valuation gaps are Japanese equities. So the long-term valuation CAPE metric is 32.5. It's risen from 21.2 last year to 23.8 now, but it still suggests there's some value. But we have been seeing highs in Japanese equities recently, although there's been a bit of a pullback. Other areas that might be of interest are mostly emerging markets. So there are emerging markets like Indonesia, I'm looking at the data here, South Africa and Mexico. So there's a number of emerging markets that still offer value. And if you want the full data, like I say, you can look at the 80/20 Investor research. Now, what about Europe? So I've mentioned lots of other countries outside of Europe. France is expensive based upon historical norms. Germany, on the other hand, is still offering some value. Now, as a general observation, nearly every market, whether that's emerging or developed, has generally become more expensive than this time last year, and that's because equity markets have performed relatively well over that period. But there are those value opportunities, and in the European space, Germany is one of those. And another market that is relatively cheap by historical standards is China. So that's another emerging market bet, but Chinese equities from a valuation perspective are still considered cheap. Now, for the wider emerging markets as a collective, they are actually in line with their long-term median CAPE valuation. This time last year, they were just below it. So they are, at the moment, good value. They're not cheap nor expensive. European equities and global developed equities are more expensive than they were last year. And they are also significantly above their long-term median CAPE valuations. Now, if you want to look at valuations at sector level, you can do that. I've done it for the S&P 500. And if you look at the historical 10-year average for CAPE, then the real estate sector is the cheapest in terms of it's got the widest gap between its current valuation and its 10-year norm for CAPE. If you want to look at the more expensive, then tech stocks, unsurprisingly, are increasingly expensive, more expensive than last year, and their CAPE is almost heading towards twice the 10-year average. And another area I'll just mention that is offering relative value compared to historical norms is financial services. So there you go, Andy. There's a bit of a whistle-stop tour of valuations. I mean, these are broad numbers, but it does mean if you want to have a valuation tilt to some of your investing, then you can explore some of those areas, even if you are applying other styles of investing, maybe like investing in smaller companies or indeed something like momentum.
Okay, so let's move on to the next piece of the podcast then, and we're going to be talking about overdrafts because Lloyds Banking Group have made some big changes to how they deal with overdrafts with their customers, and we've done an article which we'll put in the show notes, and that's on the Money to the Masses website. But Damien, you wanted to explain a little more about the changes that have happened, but also the history on what led to where we are today.
Yeah, so to give some backstory to this, if you go back to 2020, the FCA, so the Financial Conduct Authority, which is the regulator of the financial services in the UK, decided that the banks and building societies were unfairly treating customers because when it came to unplanned overdrafts, they were being charged much higher interest rates than, or typically, than customers who had planned overdrafts. And often the unplanned overdrafts were being charged at 40%, and people who had planned overdrafts, the interest rate could be somewhere like 20%. Well, in their infinite wisdom in bringing these rules in, the way they were obviously reacted to by the banks and building societies as they just generally speaking upped the rate that most people paid on their overdrafts towards that 40% limit. And with the benefit of hindsight, perhaps the FCA should have realised that's what would have occurred. Now, just to point out as an aside, that we are in a world now where overdraft debt is typically more expensive than credit card debt. And that's because if you look at the average APR on a credit card, it's down towards the sort of low 20% area. So you're paying something like that versus something more like 40% on overdrafts. And that's changed. I think a lot of people haven't actually changed their mindset. They probably still think that credit cards are more expensive than running an overdraft for a period of time. Now, with that said, what's happened in the news this week is Bank of Scotland, Halifax and Lloyds customers could potentially have the interest rate changed on their overdrafts. And it could mean in some cases that the change could push the rate up to 49.9%. So we're almost at 50%. The issue is that customers won't yet know exactly their new rate, if it will change or if it will go up or down, but they will be told by the relevant banks. But just to give you a steer, some customers currently pay 27.5% with Lloyds, and that's because they're part of the Club Lloyds arrangements. They've got a Club Lloyds account, and they're the accounts where you can pay a monthly fee. It can be waived, but you can get a better overdraft rate. But most people with Bank of Scotland, Halifax and Lloyds pay 39.9%, and there are some customers that do pay 49.9%. But the new rates that are going to come in are varied, so they go from 19.9% all the way up to 49.9%. Now, the thing I wanted to really focus on is the rate that you will get will be based upon an affordability assessment, and that includes your credit history, but also how you use the accounts. Now, this is something a little bit different, and so it's likely, I would argue, that we're going to see more of this in the future. So where most customers were receiving one higher rate, now we're going to be seeing a range of rates. It's going to be actually tailored towards the customer. So as I say, you are going to be told, you're going to be given notice. It's going to be 60 days if your rate is going to go up, and the rate rise will come into effect from August this year. But if obviously you're going down, then the notice you're going to get is only going to be 7 days. Now, of course, you might be unhappy with these changes. So, for example, your overdraft rate is going to go up. Then, of course, you could ask to be changed to a different account, but it's probably unlikely that within Lloyds you'll necessarily be able to find an alternative account that isn't going to charge you a similar rate. But you are free to shop around and look elsewhere. So, for example, First Direct offer small overdrafts that have 0% rates on them, so up to £250. So that's something you could go and look at. Alternatively, you want to try and get out of your credit card, you could try and use a specialist 0% money transfer credit card. We'll put a link in the notes of this podcast to the best credit cards in the UK. There's an article that we update regularly, and we've just updated it actually, and there are some money transfer credit cards in that article. And the other thing you can of course do is you could complain if you're unhappy with the changes, and that's because the FCA have said that it does expect banks to make positive steps to help people in financial difficulties. So there is something you could potentially do, and they may be able to waive or reduce your overdraft rate. So that's something to look into. But of course, if you are struggling with debt, then you should reach out and use one of the free services like Step Change to get advice about how you can tackle your debt.
Yeah, and I think this is maybe a good message for those people who do tip over into their overdraft each month or constantly live in it but don't necessarily need to. This is an expensive form of debt. Maybe now is the right time to make that change. Maybe move money across from your savings account, because it would seem silly to earn such a small amount of interest on your savings account, but then be paying more interest on your overdraft. Maybe now's the time to make that change.
It does serve as a good reminder that if you have savings as well as debt, that effectively you are paying to save, because the interest rate on your debts will inevitably be higher than the interest you're receiving on your savings. So it always makes sense to clear your debt with savings, usually anyway. And the other thing, even if you don't have a Lloyds account of any kind, I think this piece has been a good reminder to just double check if you use your overdraft, what you are being charged, and therefore look at it and take action.
Okay, so let's get on with the final piece of the podcast then. And we're going to be talking about car insurance, and it's really just a few quick takeaways for people, just reminders really. We covered car insurance a couple of weeks ago on the podcast, and we talked about mileage and making sure that you got your mileage right when you do your car insurance renewals, and it's really just following on from that. So I was having a quick look at the data actually, and I don't know if you realise, Damien, but right now you probably do realise because you've recently done your car insurance renewal, but car insurance is now at an all-time high. The average annual car insurance premium now is almost at £650 a year, which is astronomical. I'm imagining you saw an increase in your car insurance premiums this year, Damien?
Yeah, I'm well aware, Andy, unfortunately. Yeah, when I did my car insurance this year, it did increase. And so that's what started the whole conversation about making tweaks and changes around your car insurance. And as you mentioned about mileage, at the time we spoke, and I said that obviously you need to tell the truth with regard to mileage, because there was a social media influencer out there who was telling people to lie about their mileage. And of course, you can check any car's mileage online, because cars have an MOT each year if they're older than 3 years, and that MOT states your mileage. So I can go and check the mileage on your car year to year, as people can do it on mine. So insurers have access to the mileage information for your car.
You've pretty much nailed one of the tips we were going to do quickly cover. We did mention it a few weeks.
I'm good at this, aren't I?
we mentioned it a few weeks ago on the podcast, so it was just another reminder that mileage is crucial. It does change the cost of your car insurance premiums, and it can be tempting to sort of dial down the amount of mileage you do. But as you said, Damien, the car insurance providers, they can access your mileage. So there's absolutely no point in doing that. Take the extra time to look at your MOT details, work out what mileage you actually do. Because for two reasons. One, you'll make sure that if you had to claim or anything on there, then you would definitely be covered. But also that you're paying the right amount for your cover. You don't want to be overpaying, but similarly, you can't really underpay, because you will be effectively committing fraud on that. So mileage is done. Let's look at something else. Let's look at what they call class of use. So this is the type of insurance class that you're going to be applying for your car insurance. Now there's 4 main types of class of use, and I'll quickly go through each one, because there is a bit of a crossover with some of the classes, and depending on what you do for a job. So let's go through them quickly. The first is the social, domestic and pleasure. Now, this is described as covering you for day-to-day driving, shopping, visiting friends or family, and pleasure driving, such as going on holiday, etc. If you use your car for any type of commuting, whether that be parking at work or just traveling to and from work, you do need to make sure that you select the social, domestic, pleasure and commuting option. So this again includes driving to the train station. Even if you sort of commute via train but you leave your car at the train station, that would still theoretically be under the commuting part of your insurance. Now it is more expensive to insure yourself for the commuting aspect of your car insurance, because of course you're going to be parking maybe in public car parks, on public roads, and you're going to be traveling day in, day out in that car. So it will cost you more. But crucially, if you don't say that you do that and then you end up in an accident, it's very easy for the car insurance providers to find out what you were doing on that day and what led up to an accident. So you don't want to be in a situation where you're not covered. So make sure you do that. Business use is quite obvious. That's another class type. So if you use your car as part of your job, if you drive to multiple sites in a day, then that will count as business use. And the final one, which is, it's not a new one, but it's certainly more popular for people. It's an insurance class called carriage of goods for hire and reward. Now, this covers the growing number of people who are using their vehicles, maybe to add an extra income. So I'm thinking of Deliveroo drivers, I'm thinking of Amazon drivers that do deliveries at the weekend, or even for their main job, but for doing things like at the weekend and evenings. If you do that, you do need to make sure that you select that as your car insurance class, because if you do end up in an accident and they find that you were doing doorstep deliveries and things, then again, you'll be invalidating your car insurance. And so we've talked about mileage being really important. We've talked about the class of use of your car insurance being really important. And the final thing I wanted to really cover, because this is another reason to make sure that you get it absolutely right, and it's your no claims bonus, or what's often called your no claims discount. Many drivers don't really know what their no claims discount is, and because you're filling in a lot of information online, often it can be guessed. And that's probably the worst thing you could do, because you may, for example, known you had an accident, but you can't remember if it was 5 or 6 or 7 years ago, and you just click a number in the drop down. Make sure that you don't do that, because you could well invalidate your car insurance. It really is important to get it right. What you can do, and I think, Damien, I'm going to bring you in on this, is you can look at, if you're coming up for a car insurance renewal, you can look back over your previous car insurance applications and actually see and download your no claims discount document if you want to make sure that you get it right. That's right. You've done that before, haven't you, Damien?
Yeah, so what happens often if you use a comparison site year on year, so every year you might use the similar comparison sites when you're comparing car insurance, then what it will do is it will know you're a year further down the line and assume you've had no extra claims. It will probably start to filter the number and change it to allow for an extra year. Of course, you've got to double check all these things, but you can download your no claims discount certificate from your existing insurer. Now, the new insurer you go to will often ask for evidence of your no claim, so you state what it is. They don't always actually, but you usually do. Regardless, you should download the certificate anyway if you're about to leave an insurer and you're going to go to a new one. You can find it if you log on. Most of them have a portal you can log on with, and often it's also included in any renewal documents that you get sent through. So do make sure you keep that as evidence, because you may need it in the future. If they request it, you might be wondering, well, what happens if you don't bother sending it? Well, it could invalidate your insurance if you don't. They could even cancel the insurance if you don't send it in within the specified or agreed period of time that they would have told you when you took out the policy. And there is an ability for them to check a database in regards to claims and no claims, so there is that as well. So the message is, whenever you're renewing, then do make sure you download that, because it's so easy to, as Andy's pointed out, to forget if or when you had a claim of any kind or accident. So that is one thing I would suggest everybody does at renewal.
Yeah, and if you're really struggling and you're going for a renewal, or you're going for a new insurer, then I would engage conversation with them and say that you're not sure, because Damien mentioned the database there. It's called the NCD database, and it's a site run by the Motor Insurers Bureau, and car insurance providers are able to access that and find the information. So if you're struggling yourself, be honest, be open, engage in conversation with that provider and say, can you work it out for me? I'm struggling to find evidence. That way they've got it on record that you've queried it, you're not sure, and it's then the onus is on them to find out. So that'll be a good tip there. And just really quickly to finish off this piece, 'cause it was only really those 3 main points we wanted to make. If you're going to renew your car insurance, obviously it's important to get the information right. Do take the time, put some time aside, grab a coffee, and make sure that you answer the questions right, because it is tempting to just go through the questions, go through the motions, and just get it done. But you don't want to be in a situation where you can't claim. So the things that I would say to you is to ensure where your vehicle is parked overnight, make sure you get it right. If it is parked on the driveway, then say that. If it is on the street, then say that. If it's in the garage, then say that, and make sure it's correct. Make sure that the registered keeper of the vehicle is correct. We live in a household, we've got a couple of cars, and I always forget which car is registered to either of us, because we are actually both insured on both cars, but one of us is registered on one of us registered on the other. It's important you get that right. Be truthful about who the main driver is. There's a system called fronting, which is where you actually put someone else as the main driver in order to lower your car insurance premiums. You've probably heard about that before. That is actually illegal, And not only will that invalidate your insurance, that can lead to a criminal prosecution because it is fraud. The other quick couple of bits are modifications to your vehicle. Do make sure that you mention those. Be truthful about things that you believe will bring in your insurance down. Now, what I'm talking about here is alarms, immobilizers, steering locks. If you're ticking the buttons to say you've got those, make sure that you actually have, because they will be able to check following. If your car is broken into, there will be certain evidence that they will look for when it comes to claim. And also dash cams is another thing. I've had problems with dash cams because I've got 2 car insurance policies on a multi-car policy. One car has a dash cam, the other car doesn't. And it is very easy to tick the yes button and it applies it to both cars, but actually it's only on one car. So just make sure you're careful about how you do that. So Damien, that's it. A quick whistle stop tour on car insurance. A few things to make sure you get right when you're doing your renewal.
Perfect. So that is pretty much us done for this week. Don't forget, please do review the show. Do support the show as well. One of the ways I want you to all do that, go follow us on our socials and share and like everything that we do. Regardless of whether you like it or not, that would be wonderful, because that really helps us. Go to the page on the Money to the Message website, moneytothemessage.com/podcast, where you can find other ways you can support the show. But most of those are things that will actually benefit you in terms of cashback deals or offers that we can benefit marginally from, and it doesn't impact the price you pay. So it's something that can help support the show. Do obviously follow us join our Facebook group, facebook.com/groups/money to the masses, and obviously subscribe to our YouTube channel. I think I've got them all. The list is getting longer, but that is the sort of thing we need you to support the show.
The list is getting longer. And just finally, we mentioned it before, please do engage with the video that we put out on YouTube, because the more engagement we have on that, questions, even if you're just commenting for the algorithm, we're fine with that, because we'd like to be able to spread the word and for more people really to see the visual version of this podcast. Difficult to say that, visual version of this podcast, so we can spread the word to more people. Damien, that's it. We are done for this week. Until next time.
Until next time.